So what should you be looking at? Well, you should be paying attention to what happened a year or maybe 2 years ago with the money supply. But the newspapers hardly even report the money supply. That's the big problem. People are not looking at the money supply. Changes in the money supply do affect, with a lag, asset prices, real economic activity, and inflation. It's always been the case. It's a pretty simple story.
Steve Hanke, professor of applied economics at Johns Hopkins University and the founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise. It is such an honor to welcome you back for your quarterly appearance. We always love having you on the show. Thank you so much for taking the time to join us today, Professor Hanke.
Great to be with you again, Julia.
Well, we love having you on, and my audience loves hearing from you and learning from you. And I always tell you this, but you are one of the most requested guests that we get. And so I'm just thrilled that we're going to have you on a quarterly basis. I'd love to start where I always start with my guest, Professor Hanke, and that is to get the update on that big picture, that macro view, the framework in which you look at the world and where we are today as it relates to the economy. And as you know, Professor Hanke, you can take all the time you need to set the table when it comes to that big picture macro view.
Okay, Julia, let's start with the news out of China, since depending on how you measure it, either China's, if you use purchasing power parity, China's the biggest economy in the world. If you use nominal exchange rates, it's the second biggest one, but it's big. And it's important because what goes on in China drives a lot of the commodity markets. If the economy is booming in China, China uses a lot of commodities, and the commodity markets are strong. If obviously, if things are weak, it tends to weaken the commodity markets. So if you look at the recent data that came out, the inflation rate fell again. It's less than, it went from 0.6% year over year to 0.4% year over year. So they're worried about deflationary pressures. And to put this in context, the inflation target for China is 3%. In the U.S., it's 2%. We try to hit 2. They try to hit 3. So what's going on there is a lot of weakness due to the fact that the money supply is very anemic. The growth rate is about 6% per year, and Hanke's golden growth rate, which is a growth rate consistent with hitting that inflation target of 3%, is about 11%. So it's only growing about half as fast as it should be growing if they wanted to hit their inflation target. So no surprise. Inflation is non-existent because the money supply is not growing very fast in China. So that was just the weekend news out of China. And that followed a spat of news about the fact that they're supposedly expanding. They have a big expansionist plan they put in to try to get the economy back on the rails. Now, the problem is the expansion plan doesn't have anything to do with the money supply. It's all about the money supply and changes in the money supply. That's what changes economic activity and inflation. So real economic activity gets revved up if the money supply starts getting goosed, and inflation goes up also with a lag. Of course, the key thing is a lag. It takes a while to go through the transmission mechanism and affect the real economy and inflation. So to give you some idea about this, the stock market, of course, went zooming up in China once they announced this first phases of this expansionist policy. But I think that'll be short-lived. And the reason that'll be short-lived is the expansion policy doesn't focus on the right thing, and that's the money supply. So that's China. China's kind of on going into big headwinds, let's say, because of this anemic growth in the money supply. Now, let's go to the United States. The United States, we actually have had a contraction in the money supply since July of 2022. In other words, the stock of money in the U.S. economy is actually smaller now than it was back in July of 2022. Now, we've had those kinds of contractions fairly rarely in the United States, only four of them before, and they all led to what? Recessions, or in the case of 1929, 1933, we had a huge contraction in the money supply, and we had a Great Depression. So I'm anticipating that the U.S. economy will continue to show signs of weakness and eventually slide into a recession next year in 2025. So that's the U.S. Now, if we go to Europe, the situation's even worse. The European economies are all essentially in the tank. I mean, the forecast for growth in Germany is 0.3% a year, hardly growing at all. Many people say it's actually in a recession. Then you've got France. The growth rate, 0.7% is forecast. Italy is also 0.7. So you've got very slow growth in Europe. And again, it's a result of the same kind of cycle you had in the United States. The European Central Bank goosed the money supply. They had inflation, and then they reversed things, and the money supply has been slowing down. So you have that going on in Europe, plus the fact that the sanctions that have been placed on Russia have really backfired, and they've affected in a very negative way Europe. The ones that have imposed the sanctions are paying the cost of the sanctions, not Russia. Russia, the growth rate is projected to be fairly strong, actually, in Russia. So those are kind of the, shall we say, the three big ones. We could go into more detail and get out in the weeds with other things, but as you can see, the picture isn't really that bright, and I think the markets are not factoring in several things. Number one, the markets are very pricey right now anyway. They're very high. So there's a if something's very high, there's always a risk that Humpty Dumpty is going to fall off the wall sometime, and you'll have a problem. I don't think that risk is being factored in very well. The second thing is we've got two wars, serious wars going on in the Middle East. That one is definitely accelerating, and also the Ukrainian one just drags on with the Russians just grinding up Ukraine. I think those are not priced properly into the markets. And then another big thing is this push towards transition to green, and the cost of that have been underestimated. We're never going to reach the promised land, the green promised land, on a timetable that's been laid out. Number one, and number two, the cost will be much, much higher than everyone originally anticipated. This is a classic in these big projects, these big mega projects, over budget, over time, over and over again. You never finish these projects on time or on budget. They're always way late and way over budget. So that's kind of the picture.
So what I'm hearing from you, Professor Hanke, is for folks out there watching, listening, you really have to keep your eye on the money supply and the effects they show up with a lag. So turning here to the US, we had the September rate cut, 50 basis points. I would love to get kind of maybe more of your reaction there. And why is it that there's so much focus on the interest rate side of things? It sounds like we should really be paying attention to the money supply.
Well, it's a very interesting question, Julia, because I think everyone is focused on really the wrong thing. Monetary policy is not about interest rates, it's about changes in the money supply. So that's the first point. And if you understand that point, you realize that focusing on the interest rates is just the wrong thing to be looking at. So that is one big problem, and it ties into something called data dependency. People, the interest rates show up, of course, all the time. We see them hour by hour, and people pay attention to those because they pay attention to what they're data dependent. They're like the Fed. The Fed is data dependent. It watches the data that come out day by day by day, and 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 basically they put their finger in the wind and decide, oh, are we gonna increase interest rates, because that's the mechanism they use. That's their main policy lever. They think, although there's another lever that they're using that no one pays any attention to, and that's the size of the balance sheet of the Federal Reserve. And right now, we are in a quantitative tightening phase. So although they lowered the interest rate in September by 50 basis points, they kept on what called quantitative tightening, which is shrinking the balance sheet, which does affect the money supply, by the way, directly. The interest rate effects are very fuzzy and kind of, shall we say, a little bit unknown as regards to the relationship to the money supply. And this data dependency, what does it cause? It causes a lot of whiplash, not only at the Fed, but people, normal people in the financial markets, they do the same thing. Joe and Jane do the same thing when they look at the newspaper. Every day they're looking at what's going on with the data, the new data that are coming out. And it turns out that the daily, these high frequency data that come out are very unreliable and extremely volatile. So you tend to get whiplashed around. Now, remember, back in September, that we had weak labor market numbers. In fact, they chopped over 800,000 workers off, or employed workers, I should say, off the register back in September, and a revision. And so everybody says, oh, the economy's a lot weaker than we thought. So what happened? The Fed said the same thing, and they didn't reduce the federal funds rate by 25 basis points. They reduced it by 50. Now, we had some recent data last week that looked pretty strong. The labor market looked pretty strong. And what did the markets do? And what's the Fed do? The tenor of things changed around. And now, if you look at the meeting for November 7th, the federal funds futures market, to give you the probability of changes in the federal funds rate, because that's where the market is, the Chicago Mercantile Hill Exchange, for the federal funds futures, they're indicating about a 90% chance of only a 25% basis point cut in the November meeting. And that was up about 50 basis points, but that got cut down very fast because of this data dependency. So what should you be looking at? Well, you should be paying attention to what happened a year or maybe 2 years ago with the money supply. But the newspapers hardly even report the money supply, let alone remind you that, oh, by the way, Julia, you should be paying attention to what happened in 2023, 2022 to the money supply, because that will go through the transmission mechanism and ultimately hit the economy today. So what you see with these data today, those data are really symptomatic of the changes in the money supply that caused those data to actually change. So that's the big problem. People are not looking at the money supply. And as a monetarist, of course, I I look at the money supply, because changes in the money supply do affect, with a lag, asset prices, real economic activity, and inflation. It's always been the case. It's a pretty simple story.
This episode is brought to you by Public.com. Public.com has just announced its new bond account, offering a 6.6% yield on your investment until 2028, when the first bond matures. Here's why it's interesting. Bond yields have been at their highest levels since 2009. However, the Fed just announced its first rate cut, and more are on the table. In fact, current estimates from the CME FedWatch suggest rates may fall as low as 3% by the end of 2025. The good news, investing in a diverse portfolio of corporate and high-yield bonds could lock in today's historically high yields, even if the Fed cuts rates. That's why Public.com created the bond account. It's a new way to invest in bonds and earn a 6.6% yield on your investment for the next 4 to 5 years. Go to public.com/Julia to learn how to lock in a historically high yield on your portfolio. The bond account, only at public.com/Julia. Let me ask you a quick follow-on, because you did mention like the huge downward revision of 812,000 jobs in the non-farm payrolls report, and then we had that report. I don't know, was it like it was for the month of September? I think it was last week. I was on vacation, so I'm a little bit blurry on my timeline. That jobs report showed a much more robust jobs market, at least like from the headline picture. Maybe it's a bit more pessimistic, but it kind of makes me wonder, Professor Hanke, how can anyone like trust the data when you see like huge downward revisions and swings? My assumption is, I wonder if we're going to see another revision on the latest report. Just how do you?
I think you will. The first point is that it's turning out that these data coming out are not very reliable, subject to very big revisions, and they're highly volatile. So it's just a perfect storm. When it's not like going into a measurement in physics or something in the natural sciences, where you measure the thing and get a very accurate measure, and there are no revisions in it, and you have a very good idea of what's going on. These economic data, volatile, they've been unreliable, subject to a lot of revision. That's the general point. The particular point here is that we will not see any revisions in those until after the election, because this thing is political. It's become political, these data. Mm-hmm. Or at least they give the impression of. I know the establishment in Washington, D.C. would vigorously defend what they're doing, and saying the idea that there's some politicization of these data and their collection and revisions and so forth is this nonsense. I'm not totally on board with that argument. I think maybe in the past I would have been, but there just been too many revisions lately, kind of oddball revisions. Mm-hmm. It makes me very. Let's put it this way: I'm a skeptic. I'm not a cynic. If you're a cynic, then you get into all kinds of conspiracy theories and all of this kind of nonsense. I'm just actually a skeptic, and one reason for that is this. Many years ago, in the 1950s, I'm holding up this book by Oscar Morgenstern, mm-hmm. a great economist, great Austrian economist. He was at Princeton. On the Accuracy of Economic Observations by Oscar Morgenstern. And the first date of publication of this was in 1965, Princeton University Press. See that?
Yes.
This is kind of my Bible when it comes to data. Morgenstern, by the way, Morgenstern was one of the leaders not only in data and measurement and precision and this kind of thing, but with von Neumann. The theory of games was von Neumann and Morgenstern. So Morgenstern was, not only one of my mentors, but he he's a heavy. And if you go through this book carefully, and I require all my students to use Morgenstern and familiarize themselves with it, you'll find that this idea of accuracy of economic data and problems with accuracy, it's nothing new. So that's why I'm a skeptic because of Morgenstern. It has nothing to do with current politics or anything like that.
It makes a lot of sense. And I know folks are going to appreciate the book recommendation. I want to go back to something you said, Professor Hanke. You are a monetarist, and you note that people are not looking at the money supply, and it does have change. The changes do affect with a lag. They affect asset prices, real economic activity, and inflation. And I want to dive in on the inflation point because you and John Greenwood nailed the inflation call on the upside, like right on the bullseye. It topped out at 9.1%. You guys said 9%. And you both have nailed the call on the downside. I would love to explore like where we are as it relates to inflation, where you see it headed. Would love to just go a little bit further there with you.
Okay, well, John Greenwood and I, again, using the quantity theory of money and monetarism, we have been able to nail it. I mean, for the first side, the money supply was goosed and we got inflation. And now it's contracting and we're getting a slide down in the inflation rate. Remember, the last number, just last week, it went from 2.5% to 2.4%. Greenwood and I predicted by the end of this year it would be between 2.5 and 3. It actually is slightly below our 2.5 lower end number, and it'll probably end up a little bit below our 2.5. Fine, that's we got the direction of the thing right. Maybe we didn't completely hit the bullseye, but we got pretty close to it. Because remember, everyone when we did this forecast was saying, "Oh, wait, it's sticky. It's not going to come down very fast. Inflation's a problem." That was all the talk when we came out with our inflation forecast for 2024. Now, going forward, of course, is the key thing, and beyond the end of this year, because after all, we're almost at the end of the year right now, as we speak, and I think we will go below the Fed's inflation target of 2% next year. Well, we could see numbers down, closer to 1.5 than 2. Now, what does that mean? It means that the 10-year bond yield will go down, and that means the price of the 10-year bond will go up. So if you were long the 10-year bond, you not only would be pocketing a pretty nice yield, but also you pocketing a nice little capital gain if you hold on to that 10-year bond. Now, the interesting thing with this data dependency thing, I started recommending the purchase of 10-year bonds when the yield was 4.8%. And then it went down. It went down to about 3.7 or something like that. And now it's popped up and it's up above a little above 4. Now, why did it pop up? It popped down because inflation is coming down. That's what drives the thing. But then all of a sudden, this data dependency thing came in. And last week, we had stronger numbers show up in the labor market. And everybody said, oh, the economy is a lot stronger than we thought. And the Fed is going to stop lowering the federal funds rate as fast. And all of a sudden, the yield shot up on the 10-year. It'll come down again. And it'll come down because interest rates follow inflation. Mm-hmm. And the sequence is very simple. Changes in the money supply cause changes in inflation, and changes in inflation cause changes in bond yields.
So let me ask you this. Does it typically bottom right before a recession?
Well, Uh, no, it doesn't typically bottom. Going into the recession, it depends on the depth and the duration of the recession. But typically, you're going to see weakness in overall inflation measures going into and throughout a recession. Because why do you have a recession? You have a recession because the money supply is slowed way down, maybe a year or 2 years prior to the onset of the recession in the first place.
Mm-hmm. Okay, so the Fed doesn't pay attention to the money supply. They don't take that monetarist view. Do you think, like, I guess my question is, do they not realize that if you're right, we're going to head for a recession, do they just not realize that that's the course that we're on?
Well, no, but they have a record. Their record is not very admirable. So this data dependency thing has gotten them in a lot of trouble because they just have a terrible record of predicting things.
Mm-hmm.
For example, just a big one. They never predicted the inflation.
Yeah.
And once the inflation started kicking up, they blamed it on a million other non-monetary things like supply chain shocks, oil price increases, the war in Ukraine, COVID. They had a million excuses or reasons for the flare up in inflation. And remember, they said it was going to be temporary because these non-monetary ad hoc things that they'd come up with, oh, they'll go away. The port of Los Angeles will be opened up, and that supply chain glitch will be cleaned out, and inflation will go away.
Just real quick for the folks who are watching and listening, Professor Hanke, where can they go and look and see this for themselves, or do more of their homework, look at the money supply? I'm sure they can follow you on social, obviously, and stay up to date there. But if for that curious individual, what should they do? Where should they go?
I think the best thing, I've already given you one key book that people can buy, Oscar Morgenstern on economic data. So if you really want to understand the data and problems with the data in a serious way, not getting into conspiracy theories and all these things, you read Morgenstern and you'll become very skeptical, by the way, about the accuracy of economic data. And you'll have a scientific basis for doing so. Now let me get something else. Fortunately, we have a great new book that's been published by my friend and colleague, Tim Congdon, the greatest monetarist in the United Kingdom. You see this?
Yes, the quantity
theory of money.
Mm-hmm.
Now, you can easily get that at the Institute for Economic Affairs in London. Just go to the Institute for Economic Affairs. I happen to be a member of their academic advisory board. And that book is available either online or obviously you can order a hard copy. But it's a relatively short book, very scholarly, and very clear, very well written. I'm just looking here. It's 160 pages in length. It's a great read, and that happens to be, I think, the best little book that's been produced on the quantity theory of money. It's all up to date. All the controversies are in there. It's a great read, and it's come out. It's only about a month old.
Mm-hmm. Good to know. I love that. I'll definitely link those in the notes. Let me ask you this, Professor Hanke, and you can take it wherever you'd like.
By the way, let me just mention Congdon. Congdon. There's a background. He started out as a financial journalist in the Times of London, and then went into banking almost right away. So, in other words, point number one, he can write, and point number two, he spent virtually all of his career in the city of London. as a banker and the most accurate forecaster in the UK. He has a reputation for being the top guy. And he actually, in terms of the US inflation, he was ahead of Greenwood and myself. Now, Greenwood and I are both advisors to Congdon's Institute of International Monetary Research. That's another place you can put on your website. Institute for International Monetary Research at the University of Buckingham. Now, Professor Congdon founded that a few years back and is now heavily engaged in not only instruction, but also research. So you have someone who can write, someone who knows economic theory inside and out from a scholarly point of view, but also as a banker, as somebody who's applied it. And now he's firmly at the University of Buckingham at his institute doing heavy duty research and continuing to write. He's written many books, by the way. So I just highly recommend it. It's the most concise thing available right now on the topic.
I love that. Well, let me ask you this, and I'll let you take it wherever you'd like. We do have the upcoming election. I am curious, maybe more from that economist lens. How are you thinking about the election, how that might play out, the impact of proposed policies from the candidate? I will leave it a bit more wide open for you to take it wherever you would like.
Well, one thing, let's start with who as of today, how does the thing shape up? You know, we've got little more than 20 days to go for the before we have an election. So there are two ways to look at the prospective outcome of the election. One is a subjective way, and that's polling data. Polling data are subjective. If some pollster calls you, Julia, and asks you what you're going to do and so forth, you will give your opinion, but you also might be a little bit biased. You might want to think twice and say, well, I think I'll tell that person on the other end of the line what they want to hear, but I'm not going to really do that. Mm-hmm. So the pollsters are fairly clever. They have many ways of filtering out biases and so forth, but it turns out that the polling is not really very accurate. So the polling data, broadly speaking, shows either a dead heat or Harris a little bit ahead. That's the 30,000 feet. Now, as an economist, I look at objective data. Now, what are objective data? Well, you get that from what they call prediction markets, like Polymarket is the biggest one. That's where people put their own skin in the game and make a bet on what's going to happen. And that, broadly speaking, shows Trump is gaining momentum and is ahead in aggregate and in the swing states like Pennsylvania. They keep going on and on about Pennsylvania. Trump has a considerable lead in the poly markets, in the betting market. So we have kind of a divergence right now. The polls are saying one thing, and the betting markets are essentially saying something else. So for me, it's a little bit like looking at the stock market. Let's focus. Let's get away from polling data and prediction markets and go to the stock market. The stock market, we have a subjective aspect, and that is, Julia La Roche is an analyst. She's analyzing company ABC, and she does her evaluation, whatever she's using different models to do it. And you come up with what you think the fair value is. And Steve Hanke does the same thing. And he comes up with what he thinks. He's using different models. He has a different subjective approach to the whole thing. He comes up with a different number. And we have thousands of analysts doing this, and these are all subjective. And that's what polling data are. They're all subjective. So then what happens? All these subjective pieces of information are floating around. They're available at investment banks and newspapers, op-eds, all over the place. Then people make up their minds if they want to put skin in the game and either sell something they have or buy something new. And that comes an aggregation into the market. And there's a market price, ultimately, because all these buyers and sellers subjectively, all those subjective notions come together as what? An objective price. So the price in the market is objective. The price in the stock market, that is the value of the company. Whether you think it should be something else, that's your own business. That's subjective. And that's exactly the analogy between this subjective polling versus objective market price, basically, of the prediction market. So that's where we are, and or at least how I view the the election, and I pay attention to the objective data because, number one, it's in real time. Mm-hmm. So you don't have to wait for a poll. You can see minute by minute what it is.
Right. Yeah. So a look at the betting markets. That's so interesting. I have to tell you, Professor Hanke, no one's ever called me for a poll. I don't know if it's because I don't have a landline or maybe I just don't answer calls I don't recognize. I don't know. But I'm 36 and I've never been polled. So just saying.
Well, I usually don't I don't respond because I have too many other things to do. Mm-hmm. So I am called on occasion with polling data, but so that's another reason they're biased, because they have people like me who I have too many other things mm-hmm. to do. I'm not going to hang on the phone for 30 minutes with a whole bunch of questions.
I'm sure you've looked at the economic policies of the candidates. Have you thought about those and I guess the outcome of the election? I suppose based on the betting markets, it's a Trump outcome. But in case it's not, how are you thinking about the economic policy proposals and how that might factor in?
At the broadest level, they're kind of similar in the following sense. They're both engaged in what I call economic populism. And economic populism is just a grab bag of economic policies that the candidates think they can use to basically buy votes or convince people to vote for them. So that's one level that where there's some similarity. They're both in a way economic populists. Now, the one thing that differentiates them is that if you look at the 81-page proposal package of proposals by Harris, it's really involves a lot of income redistribution. That's taking something from Peter to pay Paul. It isn't just taking $1 from Peter to pay Paul and redistribute, because that dollar, to collect the dollar and administer the redistribution program, it's going to cost something. It isn't just taking $1 from Peter and out of Peter's pocket and putting it in Paul's. It's like taking $2.65 out of Peter's pocket in a way, because taxes are required and those taxes have to be administered. So there's an administrative cost. And in addition to that, the transfer program, whatever it happens to be, that has to be administered. So that's a cost. And then the tax itself will have a distortionary effect in the economy, and that's a cost. So if you add up all the costs, it isn't, you just don't take $1 from Peter and put it in Paul's pocket and $1 is swapped from one person to the next. To do that transfer actually costs $2.65. So this is very costly. These income transfers are tremendously costly and damaging to the economy. And that's the essence, really, of what Harris has as in her package. Now Trump has some of that too, by the way. He's not completely clean. So that's the economic populism is a problem. And another aspect of both of them is what I call industrial policy, and that is the idea, and especially Harris. Harris is big on this because Biden is big on it. In industrial policy, you put decision-making for allocating capital and running the economy in the hands of politicians in Washington. And those politicians, of course, have no incentive to make the right decision. Because what happens? If the thing doesn't go right, they don't pay the cost. If capital's being allocated in the private sector, what happens? If you don't do it the right way, you make a loss. You get spanked. Mm-hmm. But the bureaucrats and politicians in Washington, they never get spanked if they make a bad decision. So it's a stupid way to make decisions about economic activity, investments, capital allocation, and so forth. So both of them have some of this, but again, Harris is much worse than Trump on this score.
Yeah.
Then we have, as part of that industrial policy, by the way, we have protectionism and tariffs, and they're both big time into protectionism. Bidenomics is basically the same as Trumponomics was when Trump was president. And Trump's going to keep riding that same horse, and it looks like she's going to ride the Bidenomics horse. So in principle, there's not much difference between them on the protectionist thing. They're both bad. In industrial policy, there is some difference. I would say both bad. Economic populism, there's quite a bit of difference, with Harris being much more engaged in economic populism and income redistribution, and economic populism is bad. So we don't have anyone on the scene like Reagan. Now, what was Reagan? He wasn't an economic populist. He was against that. He was against industrial policy. He was against protectionism. And at the end, he was what? Well, he was a free marketer. He wanted to shrink the public sector and expand the private sector. That's not what we have with these. Now we get rhetoric sounding a little bit like that if you listen to Trump, but and if you listen also to Harris. Harris, they talk a little bit about it, but not the same way Reagan was talking about it. Reagan was basing everything on an embrace of free market principles and economic liberalism.
Mm-hmm. One of my last guests was Eric Bosmasian from EPB Research. He's someone that I know Dr. Hunt has referenced before, but he talked about how government spending here in the U.S., it's about 35% of GDP. And I'm curious, what do you make of that? It seems like it's becoming a bigger and bigger part of our economy. And one of the things I learned from Dr. Hunt was that a lot of that public sector, spending, it can be quite contractionary actually to the economy. It can also impact our standard of living. Just curious, how you're thinking about the growing size of government and the implications there.
It's a weight around the economy. It drags the economy down, and the 35%. You say, well, what should it be? We could do all the basic functions that a government should do if we were around 10 or 15%. So it's and look at someplace like France. France now is up 57%, and if you read about what's going on in France, they have massive fiscal problems and very slow growth, much slower growth than the United States. it's been growing at about half the rate of growth in the United States for the last 20 years. France has, because the public sector has just crowded the private sector, the productive sector, out of the economy. So if you want slow growth, and you can get it by expanding the government and squeezing out the private sector. And again, it's this incentive thing that we were talking about earlier. The bureaucrats have no incentive to do the right thing because they don't get spanked if they do the wrong thing. If you do the wrong thing in the private sector, you get spanked. Mm-hmm. You might even go bankrupt if you really make lousy decisions. So that's one aspect and one way to think about what's going on, government versus the private sector. The other aspect is, besides the incentive thing, is just the cost. For every tax dollar that is raised, it actually costs $2.65. So if you're going to expand the government by collecting more and more taxes and increase that 35% up to 40% or something like that, you have to tax a lot more, and those taxes are going to cost you more than the dollar in tax revenue received. It'll cost you about $2.65. So it doesn't take a genius to figure out that's a bad deal.
It's a terrible deal. $2.65 for every dollar rates. That is just not a sustainable.
Think of it this way: if it's costing you not $1 but $2.65, those government projects have to have a very large benefits to have a positive rate of return, because the cost of the revenue is not $1. It's about 2.5 times that.
Mm-hmm. Well, I have to say, Professor Hanke, I always love having you on this channel. You are welcome on any time. And I know we're going to start doing this quarterly, and I am so grateful. I know the viewers are. I want to give you the final few minutes here, and you can take as much time as you need. Just, leave the audience with some parting thoughts, anything that maybe you want to revisit from this conversation and reinforce. It could be something that we didn't bring up that you would like to discuss with this crowd. And of course, let them know where they can find you on social, read more of your work. The floor is all yours, Professor Hanke.
Okay. Thank you, Julia. Well, one thing I would suggest is a new book has just been released by Palgrave Macmillan. Leland Yeager and I are the authors. It's called Capital, Interest, and Waiting. And you can maybe put that on your...
I will.
I'll send you along a link to that particular book. That was a long time in the making. I'm glad it came out. Leland Yeager is no longer with us. He didn't make it to the finish line. The Grim Reaper got him when he was 93. He would have been 100 this year. So I'm delighted that the book has come out, and that's one thing that is noteworthy. The other noteworthy thing is a new book that Matt Sakurki and I are co-authoring called Making Money Work, and that will be published by Wiley, and you also can put that up because you can pre-order that thing. It should be out, I think, in April of next year. So I'm keeping busy, busier than I want to be.
Well, we love it. And we love having you on. You are, again, welcome on anytime. We'll have to have you on when the new book comes out in April as well. And I don't know if you ever travel to New York, we have a studio there for an in-person interview. Of course, we can do the digital.
Yeah. Where is it? Because Mrs. Hanke and I live in Paris part of the time.
Okay. Well, good. Okay. I did not realize, but it's in Midtown Manhattan. So if you're ever in the city, I'm willing to fly up. Would love to do an in-person, but understand as well.
But by the way, put up my Twitter handle at Steve_Hanke, because that really is the quickest way people can follow.
Will do.
And, day by day.
Wonderful. Thanks so much. Will do.
Okay, great.